All right, everybody. Hey, welcome to Note Nation Top 42. We're excited to be rolling into Big D tonight as our virtual roadshow rolls into Texas. And we are going to share some great stuff tonight. But once again, guys and gals, if you are joining us for the first time, you can check out our entire schedule and the 40 cities that we're rolling into by going to notenationtop40.com and check it out. We're glad to have you guys tonight. If you're in Dallas, Fort Worth, you're in Texas, or you've got investments in Big D, we're glad to have you tonight out here as we dive into what's going on in the current market there. What are the statistics? We've got a lot of things to discuss here. We promise to have you out of here in less than an hour, roughly. We'll be talking, we've got people from local and also national investors who are always interested in the Dallas market. Obviously, existing real estate investors also have a big play there too, because it has been a big and a very attractive real estate market for the last few years, but kind of starting to take some lumps. We're going to talk about the statistics and the numbers that are going to affect us all for those of us that are buying there in the Metroplex. We'll talk about the second half outlook of 2020. We'll talk about some of the future opportunities to real estate investors and investors as a whole in the market, what to look for, where to look for them, and when and how to get started. So once again, thank you guys for being a part of this. If you don't know who I am, I'm Scott Carson. I've been an active real estate investor since 2002. Been buying in Dallas, been buying in Texas for years. Got a big background in finance, mortgage, the debt markets as an ex-banker, financial advisor, and a debt buyer since 2008, but been doing a lot of stuff in the finance market since 2004. I've purchased over $500 million in debt. Yes, $500 million in debt for our own portfolio. I'm the CEO of WeCloseNotes.com. That's our website where you can get more information. But I've been working with real estate investors to help them get things rocking and rolling, doing amazing things for themselves since 2004. Really enjoy that aspect of things. Not only buying for my own portfolio, but also helping others accomplish big things. I am the host of the very popular podcast, The Note Closer Show, that you can download and listen to on YouTube or anywhere you listen to podcasts. And like I said, I invest all across the country in roughly 30 different states, but Austin, Texas is home. But Dallas is just a 3-hour drive, 2.5-hour drive, depends on how fast I go and how little traffic is for me out there. Bought a lot of stuff in that market. Still continue to look at that area. But why am I doing this? Why am I spending time going through 40 markets, including the Dallas Metroplex for you guys? Because I've got a passion for helping out. I really love to help investors out. And we've got our, I guess you could say, our thumb on the pulse, especially with what's going on in the market since I've been around since before everything happening. And I was buying debt back in 2008 when the last Great Recession hit. And I love helping people, especially investors, solve problems. I love helping people finding solutions, finding ways to get around things, finding ways to make a, maybe you can say squeeze a round peg into a square hole in the proper way when it comes to being an investor. And I'm doing this because I believe one of the biggest opportunities for wealth growth, wealth increase, and changing our lives is taking place right now and will be going on in the next 24 to 36 months. It also took place 8, 9, 10, 11. If you missed out on that time, now is the opportunity for you to get rock and roll no matter what your niche is, and we'll go through that later on. And I'm also doing this because I was once a distressed borrower myself. Back in 2002, 2003, bought our first couple homes, got laid off. My tenants got laid off from their jobs, so I understand what it's like to be a distressed borrower. I empathize with people who have lost their job, who can't afford to pay their rent, who can't afford to pay their mortgage. I've been there before. I understand it. And luckily for me, I had some people that helped me out of the situation, and I want to help as many Americans out there as I possibly can, primarily investors out there. And there is nothing greater in life than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. A lot of people are facing some what they think impossible situations right now. Yeah, it's difficult for everybody. But the more you can help people out and really create true win-win, where everybody walks away from the table happy and thinking they won, that's a good day. And we can still do that in today's society. We can still do that with what's going on right now with the pandemic, okay? And I have a big goal of helping over 1,000 investors in the next 12 months really tap in to the note space, into this market, to really make a lot of good, make a lot of great tasting lemonade out of what other people consider a lot of lemons out there. And our mission is to help investors to accomplish their dreams and increase their wealth through debt investing. Look, there's a lot of opportunity out there. If you're going to sit around and wait for buy the property, you're going to be waiting a while. And I'm going to talk about why debt investors, people that are buying the debt from the banks, becoming the banks, are really in the pole position. And you're like, why would I want to do that? But the people that are in the debt game are going to come out smelling rosier, making a lot more money, making a lot more impact than the other traditional investors waiting for property, waiting to fix and flip, waiting to flip a REO. Got a lot of opportunity right now. So let's talk about what the national numbers say for us tonight. We're at 11.1% unemployment rate in June. That's the most recent numbers. July's numbers aren't out yet, obviously, but 11.1%, basically 1 out of every 9 individuals is unemployed. Over 40 million people collecting unemployment across the country. 52% of small businesses are expecting to fail, or already have failed. We expect that number to increase the longer this goes, depending on what state you're in. Obviously, here in Texas, we've taken a bit of a setback, kind of closing things back up a little bit with an outbreak, a secondary outbreak. Now, the thing that you keep in mind, before all this happened, though, 1 out of 10 Americans or homeowners was already struggling to stay current. They were already at least 30 days behind on their mortgage before this showed up. 10% were already struggling. We're already at 30 days late, okay? Now, if you look at what the current national mortgage delinquency rate's at 7.76%, 1 out of every 13 borrowers is in default, okay? That's delinquent, 90 days delinquent. Not just staying current, but that's a lot of debt out there. Some people are like, oh, no, we're not seeing anything. We have very little foreclosures. Yeah, you might now. You might have been beforehand, but that's not paying attention. That's putting a blind eye to what's going on in the country. It is not going to be the same for everybody out there as it was. There are currently, right now, 4.1 million Americans currently in default, okay? 4.1 million homeowners currently in default. Why is that important? Well, it's a lot of people, but it took, if you look back to what happened 12 years ago, it took us 18 months roughly from 2008 roughly to 2010. It took us 18 months to get to the first 1.6 million defaults in 2008. We're already 2.5 times that in 120 days, okay? We're 2.5 times that in roughly, what, a fourth of the time? Yeah. Fifth of the time, roughly. It's going to get a whole lot worse, everybody. We are going to exceed that number of 10 to 15 million people are going to be in default and facing foreclosure before the year's out. Now, yeah, government can kick the can down the road. We'll talk about what's going on with that. But we are going to see a lot of delinquencies, not just on the residential side, but also the commercial side, because I know we got some people on here interested about the commercial space. Okay, we know delinquencies have recorded record spikes in 2 years. Non-prime loans, that's the new subprime. Well, we don't have subprime. Well, yeah, you got non-prime now. It's the same thing. Saw a 21.8% increase in their defaults. Expanded prime loans saw second highs at 12.2%. Reperforming loans also experienced a 6.4% increase. And then prime loans, especially the atypical loans, also saw a 5.5% increase. 1 out of 20 prime borrowers are also delinquent on their mortgage. Okay. Now, what's it look like? And I did really well here for you guys. Some people are like, oh, I'm not in Dallas. I live in Fort Worth. Well, I'm in Fort Worth. I don't call Dallas home. So we pulled up Realty Tracks numbers for the two markets so you can kind of see that. Now, in Fort Worth, the market's actually stronger in Fort Worth when you look at foreclosure numbers wise, as far as being a better market. In Dallas, roughly 1 in every 5,700 homes is in default. Now, in Fort Worth, it's 1 in every 11, just under 12,000 homes. Okay. Now, in the top 5 zip codes, 75216 is 1 in every 1,500, whereas 76103 is 1 in every 5,789. All right, so you can look at these numbers and see the top 5 counties out there. Didn't really show up on here with Realty Track with a map, but you can see it's the difference between the haves and the have-nots for the most part, especially on the Fort Worth side. We look forward. The numbers pulled basically as far as May. All right, May 2020 numbers, looking back a year, prior month. It was an increase in auction properties in Dallas. It was a decrease in auction properties in Fort Worth. Year over year, it was down just a little bit in Dallas, quite a bit in Fort Worth. Bank-owned properties was up 600%, okay, in May compared to down to 85% in Fort Worth. So it's an interesting kind of stat. If you look at, you can see how the charts really dropped off in Fort Worth. People really stopped there in Tarrant County, while in Dallas, you saw a spike in May, whereas the rest of the country, all the other cities have shown basically nothing on May, but that didn't stop Dallas. Everything's bigger in Dallas, right? Everything's bigger in Texas. If you look at the numbers here, this spike of auction properties in May is unique to Dallas, really, compared to a lot of the other places. And we've talked about New York and LA and San Francisco, Seattle, Washington, D.C., just to name a few. And this is the only really area that's seen a spike so far in auction properties in May. Everything else has been looking more like this reduced bell curve a little bit. Now, if you want to look at unemployment in Texas, Texas as a whole actually improved from April to May. Okay, 13.5%. It improved a half a percentage across the state to 13%. Well, Dallas, you can see that there, 13% in May. Now, if you look at Dallas-Fort Worth as a whole, which it does it there, it's actually improved as well. April, Dallas-Fort Worth was 12.8 compared to the rest of the state, and it improved a half point to 12.3%. That's still higher than the national average. Now, if you're looking at unemployment, Dallas being one of the top, Dallas-Fort Worth area, sorry, everybody, being one of the top 12 markets in the country out there, they had an interesting chart that I was able to pull up for you guys, kind of comparing Dallas here to all the other top 12s as far as job loss, non-farm employment over the year. And Dallas wasn't too bad. Dallas was reduced compared to a lot of the other cities across the country, only down 6% across the board. It was the second lowest job loss compared to a lot of the other cities. But it was one of the, Dallas is also one of the unique markets to gain at least 1,000 jobs in any super sector with an increase of 9,000 jobs in financial activities. Now, you think we have defaults, foreclosures? Do you think banks are going to be in trouble? Yes. Do you think banks are going to be laying off? Yes. Financial institutions are going to be laying off? Yeah, sure as hell is. We're going to see that like we did beforehand. All right. So keep that in mind. And I got some numbers to run across the rest of the state too for you guys. So let's talk about some of the foreclosure numbers. You know, when you look at where the default rates are, what kind of the interest rates is for the future foreclosures, it's all across the board here. Now, leading the foreclosures really are the Fannie Mae, the FHA loans. First-time home buyers are at almost 10% default. That's because people are getting in with no down payment or very little down payment or no closing costs, whereas a lot of banks, we were seeing this with Bank of America, and I'm going to bring this up. Bank of America previously was donating the down payment to 3% or 3.5% for Fannie Mae, and then paying up to 10 grand towards your closing costs on Fannie Mae loans. Okay, now conventional loans were the lowest at 3.16%. You have your VA loans at 4.36, and then the rest of the loans at 4.65. That's why the default rate on average is 7.76, but ticking up. You can see it's a tick up from the last quarter of 2019. First quarter was up. We know that the end of second quarter, when the numbers come out here, probably in the next few days, we're going to see another increase. Obviously, forbearance agreements are a big discussion. What's going to happen with that? Forbearance numbers have dropped a little bit as people have gone back to work. Okay, I can go back to work. I can start paying my mortgage now. Well, if they're being laid off or put back on furlough or stay-at-home orders in place, which we're seeing in Texas, that's going to climb back up there. So national-wise, we're across the board, roughly about 4.7, 4.8 million borrowers of forbearance agreements. Obviously, you have the Fannie, Freddie, several million, FHAs, quite a bit, other different loans. But altogether, you've got that huge amount of people across the country that are in forbearance, hoping to drag this thing out for another 6 months, if not longer, to stay in their house. Now, I pulled up this chart. I thought it was pretty interesting. This is a serious delinquency on a state-by-state level over last year's numbers. Okay. Texas had really no change in delinquency from 2019 to the start of 2020. When you start looking at some of the different markets, when they start breaking down, you can see that the decrease rate in Dallas actually went down some. Or stayed the same for the most part. Sorry, it was no change in Dallas. But you see in other parts of Texas, Tyler, especially the Houston market, it was hit very hard because of the hurricanes and things like that. Some places out in West Texas out there have been affected because of the oil industry as well too. So that's an important thing. But what you have to realize is that while we may see current late payment rates in home foreclosures at a low, that's right now because everything's been stopped. So the news is talking about these, it's low foreclosure rates. Yeah, right now, but what's going to happen in August? What's going to happen in September? Let's see a variety of things. And these numbers are through through April. And you can see how kind of Dallas compares to the rest of the Texas market. In March, 30 days delinquency was only 3.7. Serious delinquency was 1%. Okay. Houston was the highest at 4.9 and 1.4 serious delinquencies. but this number has tripled across the board. Tripled, if not getting close to quadrupling that in every market across the country based on everything that we see. The greatest increase in late loan payments were in the properties between 300,000 and 600,000. That's really where the Dallas market is at. A lot of higher priced homes. There are going to be a lot of delinquencies. A lot of stuff in that neck of the woods are going to struggle. Below that, not seeing so much because people are coming together. We start getting that higher price at secondary level of home buyers buying that upgrade. That's where they have the most amount of impact because those are the people that are being affected the most. Now, is that good news or bad news? Well, 6.6% of DFWs are in default. Okay. I know that number that I just showed you shows a lower number. This is a much more current number. This is as of June, 6.6% DFWs, okay? 3.7% missed in March, okay? That number still is, we're very lucky in Texas. Texas is one of the lowest default states in the country. Not the lowest, but one of the lower country ratios. And we do have a shorter non-judicial foreclosure for FHA foreclosures, 390 days, but with traditional loans, Texas is the fastest foreclosure state in the country at 30 days, 21 days after by the first Tuesday, 21 days prior to the first Tuesday. If you have a traditional loan or non-government backed loan, you can foreclose relatively quickly, which makes Texas a great lending state. We have so many banks that are doing business here. And I'll talk about that in a second. But still, though, the backlog of foreclosure agreements, plus the fact that we've got some moratoriums put on the foreclosures for a little while, we'll talk about that here in just a second. It's going to be a while before REOs hit the market. And because of that, I mean, we're going to see some, but you're not going to see the rapid flood that we saw beforehand. It's going to be 12, 18 months before we see a lot of the REOs hit the market. And that's where a lot of investors are like, oh, I'll be ready in a year. Well, why wait a year? Most of those deals will probably be a smaller percentage than what you're expecting because a lot of people are going to be buying the debt. A lot of banks, a lot of institutions are going to dive in and buy the debt. Now, here's the foreclosure protection for Texas. States as of June 17th, I'm sorry, let me go back here. Fannie Mae and Freddie are extending the moratorium for foreclosure evictions through August 31st. So we've got another month and a half of moratorium on foreclosure evictions. They're not even starting anything until August. Okay. Now, what's also prepared is that Fannie and Freddie are expected to automatically give people another 6-month forbearance agreement. They're already talking about doing that. Okay. So what does that leave for Dallas County? Well, we all know all foreclosure sales are still canceled until further notice. We know that until after at least August. Tax foreclosures, that means, see here, you guys, if you're not getting paid, if you're a tenant not paying your rent, you can't be evicted for a while. If you're a borrower and can't pay your mortgage, yeah, you can't be foreclosed on, but at some point it's going to come due. And if people aren't paying and they aren't getting evicted, it's a big problem. Defaults are going to increase quite a bit in Q3 and definitely Q4 if the state continues to worsen. Okay. Now on the residential side, what about the commercial debt? People ask me about. Well, we know that's crazy. We're seeing for rent signs all across the board. Commercial markets are been hit. A lot of office space in the Dallas market. We know retail's been hit hard already. Malls have been struggling in the Dallas-Fort Worth market. 52% of small businesses. That number may increase by another 33% to roughly 60, 65% if it gets really, really difficult. We know big companies like Neiman Marcus, obviously, Subway, others out there that are struggling. We know the commercial boom has come to a quick halt with $50 billion in market share lost in March. And it's going to be even worse here. And let's talk about some of those numbers. 1 in 4 hotel loans are in default. Yeah, 1 out of every 4 hotels you look at, we driving by, are already not just behind, they're in default. Some have been in default for a while, going back to March, okay? 1 in 4 retail loans are in default, okay? Office vacancy is set to increase to roughly around 20% nationwide and be worse in the Dallas markets, probably 25%, okay, if not higher than that. You should expect at least a 15% or higher vacancy rate for retail and restaurant space. We know Dallas has plenty of retail, plenty of restaurant space, so that number is actually going to be higher in the geographic market of Dallas and Fort Worth both. Probably worse in Dallas than the Fort Worth market, with Dallas just being bigger. You're going to see rents across the board decrease at least 10% by the end of the year, if not 15% to 20% rolling into 2021 in the commercial space. So what does that mean? If you're going to buy a commercial property and be involved in commercial property, you got to look at working with your tenants if you can. If not, you're going to put new tenants in place. You need to be at roughly 80% of what market rents would be like this just to be probably competitive. Okay? That's across the board. Delinquency rates triples in the U.S. commercial mortgage markets. Definitely $1.3 trillion of property loans. Fear worse is to come. And that's the thing you got to keep in mind here is that beforehand, there was a lot of commercial mortgage-backed securities that were financing this stuff, the big boys. Well, it's different this time around. This time around, banks have been financing roughly 53 to 63% are originated by the banks. The banks have been carrying the paper a lot more than they used to beforehand. And it's just the tip of the iceberg, okay? They're financing this stuff at 65, 70% of value. Markets come down, the market values drop, which you know what they're going to do? They're going to go to the borrowers and say, listen, I need you to bring another 10 or 20% in cash to the table because your value has dropped 20%. I need you to be no greater than 70 cents on the dollar. I just got a text message from an investor in Arizona, an investor in Texas here who's got a apartment loan that the bank is not going to renew. It's at 50% LTV, he says. Not going to renew it. He needs a final loan, a refinance. The bank canceled the refinance they were going to do. They weren't going to pretend to extend. He's been pretty much roughly at 85% occupancy and collection ratios. Okay. Now, what does this mean? Now, the banks, most of your local banks, yeah, they're financing some big stuff, but they're really catering to a lot of the investors like you and me out there. Business owners in the local market are financing stuff. It's literally going to be a lot of opportunity for us that we can step into. And you start looking at what some of the big guys are doing, what they're saying. They've been talking about this since March. If you're track commercial real estate, you probably know this name. Carl Icahn, he's a big guy when it comes to commercial mortgage-backed securities and the commercial markets. Talking about it, he knows he's been saying it was going to blow up, and sure enough, he predicted it, and it did. It's going to be 2008 all over again, but potentially worse. It's going to blow up, and nobody's even looking at it, as he says. Okay. He goes that he's shorting the commercial mortgage bond market, and it's his biggest position by far. That's going to affect everybody else out there. Yeah, money is cheap. There's a lot of money on the sidelines, but you're going to have a lot of short sales. You're going to also see a lot of the credit default swaps failing like it did. Big short all over again, but hitting the commercial markets first before it does the residential markets. Because with the government extending things 6 months or another kick the can down the road for the 6 months, nobody's bailing out the commercial markets. So commercial markets can take it the hardest hurt. And the biggest opportunity, do I have that in here? I'll get that in a second here. But it's the same thing. Delinquency lurch higher. Commercial defaults are increasing. Commercial bank loans associated with hotels at 24.3%, up from 19.3%. Loans say with retail properties, we're dealing at a rate of 18. That's up to 20%. Multifamily loans, which were less than 2%, stood at 3.29, almost, in June, it will probably double. Office, less than 2% being there, edged to almost 2.6 in June. You're seeing default rates. Those are national levels, but when the areas where those assets are more concentrated, you have a higher default rate. And Dallas is one of those. Banks are going to stand to lose roughly $48 billion in commercial real estate loans. Okay? Over the next 2 years, they're going to lose roughly $48 billion commercial real estate. That's a huge gold rush for all of us out there. Why? Because the banks have distressed debt. They can't kick the game down the road as far as they can on the residential side. They've got to do something. They got to get off their books. And today, literally today, this morning, July 16, 2020, article came out in Bloomberg. B of A sets aside billions for soured loans and their shares decline. Not only Bank of America, Wells Fargo, Chase, Citi, all have been setting millions aside. Just on Bank of America side, which is obviously one of the bigger domestic banks here, it's kind of the bellwether curve for everybody for the most part. $5.1 billion they've set aside in expected losses. Just them alone, $5.1 billion is what the article talked about. Okay? Ouch. Okay? It's going to get ugly, but it's also going to get really good for some people who understand the opportunities out there. DFW's $943 million in commercial mortgage-backed security debt coming due. All right, this article actually went out and tracked 700 of the bigger properties in the DFW market, and over a fourth of them are going to be in serious fallout. Okay, nobody's going to refinance this stuff, especially when you're looking at the hotels. What the hell? Hotels are going to be cheap like they were back in 2008, 9, and 10 again. So where are the opportunities? Is it waiting around for the foreclosures and the REOs? No, that doesn't. You can, but that's not really where the opportunities are. Okay, most of your residential portfolios are going to be bundled up and sold off from one big bank to another. Yeah, you'll still see some one-offs take place, but it's not the opportunity. Really, it's what's going to be running the market the next. Fix and flips? No, you're still waiting around. Fix and flips, there's not really money that's going to finance some of that 75%. Now they're going to be rolling back. Hard money lenders are already starting to pull back with their financing, especially as the markets drop. Rentals, who wants to be a renter or landlord when your tenants aren't going to pay you for 6 months? Okay, when they can't afford to pay you on your full market rent. Now there are things we'll talk about in a second here. The real opportunity lies in the debt game. If you can buy the mortgage at a substantial discount, and I wrote the book on it, how to buy mortgage debt at 30, 40, 50, 60 cents off on the dollar. Been doing it for years. That's where the real opportunity lies. When you can buy debt at something such a steep discount, it gives you a lot of flexibility to either negotiate with the borrower or negotiate with the tenants on the commercial side, or to buy it, hold on to it for a while and regentrify the asset, wait for the value to come back. We're going to see residential notes start to hit the market a little bit here in the fourth quarter. Not going to see much this next. They're going to say, oh, foreclosure rates are still low. Yeah, right now. But the fourth quarter, why the fourth quarter compared to next year? Because banks already know what they've got in their books that's in default and forbearance agreements, and they're going to look to move that stuff before the end of the year so that when it does eventually default, they're not the ones holding on to it. They're going to look to kick the can down the road, let somebody else take it, and they're willing to take a discount to avoid another apocalypse, okay? But right now, we're already starting to see commercial notes. I'm getting more people calling me. I've talked to more guys, and they're starting to see more deals in the commercial space than they've seen all of last year or 2018 combined. And you're going to have to get a little creative. You know, hotels, we used to be really hot. Now they're not so hot. You might need to be like this guy up in Illinois, in Arlington, Illinois, who took this hotel and converted it to an apartment complex. Obviously, we know apartment complexes have been hot, but they're seeing their share of defaults as well. But, hey, if you can really reposition the asset and get it leased up, you can really build a nice value there. My buddy Garrison Gilbert is doing this in Pennsylvania right now. He bought a 55-unit hotel, and he's turning it into a 42-bedroom apartment. Getting it cheap. You're going to see a lot of those non-flag, non-main company, non-main chain hotels. The mom and pops are the ones that are going to hurt the most. They can't afford to be at a 30% or 20% or 40% occupancy, especially with everything going on. And you look at the Dallas market, what's going on in Dallas? Tourism, baseball, hockey, basketball, okay? You look at all the colleges, college football, TCU, SMU, and all the other colleges around there. If you're not going to have college football where people can come, you're going to miss out on a lot of opportunities. So that leads to great things if you can buy that debt at a discount, which you can, and be able to do. You're going to be like this guy in Seattle. This guy took an office space and converted it from 170 doors in office space to 170 self-storage units. I think I thought Jim Ross on here earlier. Literally, I love this strategy. He took it, they got 7 covered parking spots and converted the office just to self-storage. They're basically 10 by 10. So he did that, and basically it's for sale. And so I'm like, ridiculously priced, but it's in a place that makes sense based on the cash flow. He's getting creative, okay? Now, are the banks in trouble? Yes, we know there are banks in Texas that are in trouble. Texas has always been a mainstay, or banking has always been a mainstay in the Lone Star State out here. Now, by looking at the most recent Bauer Financial numbers, if you don't know what Bauer Financial is a company that takes a look at banks and credit unions, quarterly reports, they rank them. They give them stress tests. They look how they rank, or they rank them 5 stars, look at their 90 days, look at their 30 to 89 defaults, their commercial defaults, all these other things. They give them rankings. And based on the June rankings, which are the most recent ones, we all know that there are thousands of banks that have offices in Texas. Just about every major bank in the country wants to be in Texas because we do have the friendly foreclosure laws. But there are 128 banks that are based solely in Texas. I mean, their main offices are in Texas. When you look at the host offices, you look at those numbers, it's really kind of scary. In those 128 banks, there's over $2 billion plus in loans that are 90-day late right now. $2 billion plus, and at least that number, if not more, in 30 to 89-day lates. So they're not quite default. They're still in that 3-month window. But once it goes beyond 90 days, they're in true default. You got a whole other wave coming. Okay. On average, roughly about 5% of each bank's loans are at least 90 days in default. That's not a good point. Remember, going back to 2008, all the models said, oh, we'll never get to 8% default rate. If we get an 8% default rate, we're in trouble. And of course, we shot way back that. Well, we're getting there. Texas, yes, we're a little bit lower than the rest of the country, but it's climbing. It is climbing dramatically. And I'm interested to see what the numbers show in the next quarter when it comes to this. I wouldn't be surprised we're close to that 8%. Now, if you look at those, out of that $2 billion, $500 million, a quarter of it is roughly in single family homes. 1 to 4 family, 1 to 4 family homes in default. And another, just about equal to that number, a little bit higher than that's in the 30 to 89 days. So you get a big wave of foreclosures that's going to get kicked down the road. They're getting kicked down the road. The two bigger banks that are they're based in Texas that are struggling. Beal Bank is one of those, has 122 million. Over 19 branches, okay? $122 million in 90-day single-family defaults. And then you have Plains Capital Bank with 65 branches, has 101 million in defaults. All right? We always talk about, well, who has the stuff? Well, there's right there, too, for you. And they got commercial debt, too. And both, especially Plains Capital, has a lot in commercial debt that's in default. A lot of stuff. So why would you want to buy the distressed debt? Let's talk about that. Well, you can start purchasing the debt now, start making things happen, start getting deals now versus waiting 6 to 12 to 18 months down the road, competing with every other wannabe real estate investor out there, okay? You can purchase the debt at significant discounts. Once a bank forecloses on a property, becomes an REO, you don't get that big a discount like you used to anymore. You get a big discount by buying the debt and then having to take care of the foreclosure, having to solve the bank's problems. And you'll get a bigger discount depending on the location, the foreclosure time frame, the values, condition, what's going on with the asset. On the residential and the commercial side, it varies, okay? You can control the asset. I mean, that's beautiful. I don't care if there's a second mortgage on it. If I'm in the first lien position, I'm controlling the asset. If I'm picking up at 30 to 70%, I have all the flexibility in the world to be able to keep that borrower in it, keep that tenant in place, to work with a homeowner, whatever I need to do, okay? Whether it's loan modification, loan reinstatement, short sales, short payoffs, loan sales. The beautiful thing about commercial debt, too, is a right to collect rents. You have the right as a commercial bank, commercial lender, when you buy the note, you become a lender, to go straight to the renters and collect the rent directly. So that if your borrowers are not paying you and they're using the property like an ATM, you can nip that in the butt really fast. We've done a lot of that in the past. You can take over the note and turn it into a cash flowing note, a performing note. A lot of opportunities for you by being the bank. All right. Do what you want with the property. If you want to keep it, great. You want to regentrify it, great. You want to turn around and sell it, foreclose, sell it to somebody else, you got all the opportunity in the world for you. Some of the other advantages note investing out there is kind of a monetary one for those that are looking to get into things. A lot of investors are spending thousands and thousands of dollars on direct mail marketing that they don't have money to. So we do 0 direct mail costs. We're not going to be mailing postcards or yellow letters out to the banks. They're not going to accept that. If you've got the ability to send an email or to make a phone call or jump on LinkedIn, you can do this business. And it was funny. You start seeing things. I've already had, what was interesting today, I started seeing maybe 4 or 5 special asset managers send me invitations to connect. And that's the job title, special asset manager, secondary marketing manager. Those are the job titles. And when they're starting to reach out to note investors, note buyers, you got to start paying attention to that, everybody. All right. And the beautiful thing is that one source will lead to regular deal flow. Unlike direct mail, I'm going to mail out 5,000 postcards to get 1% or 4% from people that have one deal that I might get. Well, no, if I make a bank connection, I'm going to be fed from them on a quarterly basis for the next 2 to 3 years. 1 deal, 10 deals, 100 deals, 1,000 deals. It'll vary, not just what's in the Dallas market, but seeing what else is in other parts of the country as well, too. And I can cherry pick the assets, the best deals from my own portfolio if I want, or I can put some money together and buy in bulk and get even better pricing if I need to. Like I said, you can do this with residential, commercial assets, both. Like I said, you're probably going to see a delay till the fourth quarter on the residential side, but you're going to see commercial assets already starting to hit the walls. And if you want to, look, you can raise plenty of capital from other investors to fund purchases. It's been done for years. Plenty of money sitting on the sidelines out there to make a lot of opportunities. If you think about this, if you go back 12 years ago, or actually 10 years ago, at the peak, there was 15 million homeowners underwater. The peak, 15 million. We're already a fourth of the way there, but in a fourth of the time. We're going to see a lot more than that happen, okay? Now, are there investors out there? People ask me, well, this sounds great, Scott, but I don't know if there's investors out there. Look, there is a ton of investors. I don't care what part of the country you're in. Dallas is a hotbed of investors out there. A lot of money. There's $9 trillion in retirement funds sitting out there across the country, and we've got our fair share in Dallas, being with the oil industry, the gas industry, technology, a lot of big money in Dallas, okay? 77,000 investors have an IRA in the Dallas market. 77,000 have an IRA of some sort. That's not 401k. 401k is an even bigger number, about 100, over 100,000 plus, maybe closer to 500,000. Did pull the numbers on it, but I pulled the numbers on those that have an IRA. Now, out of that number, 77,000, 53,000 of them, basically 67%, have at least 150 grand or more in their accounts. Woo! How many people do you need to talk to have 150 grand or more? Do you need to raise $1 million to take down a property? You don't need that much, okay? Don't need that much at all. A lot of people have money sitting on the sidelines making zero to little in CDs, certificate of disappointments, or 401ks that were 101ks that need to move into something. They're wanting you to give them a phone. They're wanting you to talk about their deal. There are so many investment clubs in Dallas that you can raise capital by just getting out and sharing what you've got going on. Because there's 63,000 freaking real estate investors in Dallas area. There's more than that, but there are 63,000 people that file taxes every year that call themselves a real estate investor. That's a lot of people looking for deals. If you can find the money or you go find the deals, you've already got 2/3 of the situation figured out for you. You go find the deal from the banks, there'll be people waiting there for you with money, or people to buy the deal from you if it's not something that you want to take down. It's like shooting fish in a barrel, everybody. You just got to put a little work into it, okay? Now, the question I'm always going to ask people is, do you want to be the bank or the banker? Or the banker or the bar? Well, everybody says, I want to be the bank. Well, that's the truth. But every one of us is in the note business already, but you're already on the borrower side. You got money going out, not money coming in. And I don't care if you got a car payment, mortgage, credit cards, student loans, medical bills, whatever. You own your, Bubba down the road, $1,000. You're in the IOU business. You're in the debt business. I would rather be on the payment side, the receiving, and be the bank, because the bank is always going to win, everybody. It's set up that way with arbitrage. It's set up in the documents. It's set up in the loan agreements. The bank is always going to win if something goes south. And you might as well, can't beat them. You might as well join them. You might as well play by their rules and start buying some of the stuff, maybe stealing some of the stuff for pennies on the dollar of what they did beforehand. A lot of opportunity out there, a lot. So how do you tap in this tsunami, everybody? Look, I've been teaching real estate investors all across the country about note investing, teaching them how to tap into this market direct from banks since 2010. I bought from Wells Fargo, Capital One, you name a bunch of them, I bought from them, okay? There's a lot of opportunity, I've helped thousands and thousands of investors purchase their first non-performing note or their first performing note for their own portfolio. We've done it on residential or commercial notes. I'm not talking about one deal and that's it. No, I'm talking about hundreds and hundreds and hundreds of commercial deals and thousands of residential deals across the country. And whether you're looking for cash flow or asset growth, now is a great opportunity for you to dive into it. If you want to buy in one-offs, cherry pick, like I said, you can, or in bulk, you've got that opportunity. We've seen a lot of average trades. People get started for as little as 25 grand on a residential loan, up to 5 million on a larger commercial property. From one deal to 185 deals in one trade, we've done it, okay? We've done it, we've been there, we've got the scars and the t-shirt to walk you through it, to show you how to do that. And I don't care what you're going through. I don't care if you're a deadbeat borrower right now, you're in forbearance agreement, you're unemployed, okay? Or you have a job you hate. The bank doesn't care when you're buying a note from them. They don't care what your credit is. They're not checking that. They're not going to care about where your funds are coming from. If you're borrowing it from one person or buying it, putting it together in 10 in a fund or something, they don't care. They just want to get it off their books, okay? And as I said before, if you've got an email address, a professional one, phone, and a LinkedIn profile, you can do this business. You can do this business easier than most of you think it would be, okay? And I don't care whatever your focus is, whether it's single family homes, apartments, hotels, rental, retail office, self-storage, mobile home parks, whatever it might be, there are deals in all asset classes. All right. And the beautiful thing, though, is you can really do a lot of good by helping people out. You help borrowers out, just like this borrower. She lived in her property for 18 years, did a refinance, pulled some equity out of the house a few years back. Market crashed. Then her husband got sick and I had a heart attack. She was trying to do a loan mod for 4 years. When we bought the note, we bought it a huge discount. We reached out to him, negotiated a loan mod, got her to restructure her loan with us. Actually, we restructured the loan stuff on our side with her approval, and we were able to get her to have her house paid off in 7 years versus 33 years. And we really helped her to take that nightmare, what was once her dream, what turned into a nightmare, back into the dream again. Still living in the house. House is now paid off, though. And we were able to make a really nice return and a true win-win for the borrowers out there. And that's what we love to do, is creating win-win scenarios, not only for us, but for the banks and the borrowers. Oh, fourth one, for our investors as well. Do you want to do it big or do you want to do it small? It's up to you. A lot of people get all started small, just like Gene. Gene's out of Elkhart, Indiana. And Gene was buying a little one deal here with his own money, doing a little fix and flip there. And Elkhart is a hot shot truck driver across Indiana and Illinois. And when we met him and showed him to change how he approached things and showed him how we did things, he's been able to really up his game. So instead of doing like one-offs here and there, he's now put a fund together, got over 13 million in private capital out in the market, closed on over 134 deals, and really changed the way he's done. He's gone from small to big time, and we're really proud of him. Same thing can be said for Laura Blunk. Laura's done an amazing job buying, being a first time, not really first time. She had some real estate experience before she got involved with us, doing some wholesale deals, some light fix and flips, really trying to find her spot like most people. Probably going to too many seminars and not have enough action like a lot of people do. They get overwhelmed and a confused mind says, I know mine, right? Well, she came to our training. We taught her how to do the right thing. She bought 2 assets. A few months later, she bought 14 in the second trade. And then I think she's over 100 now and getting ready to close on a very big deal. Brought for about $4 million purchase, over 100 performing notes for her portfolio. It's going to be life-changing for her and her family and her future. So we're really proud of her. Keith Collins here, done a lot of real estate experience in Ohio, also not only on the government side, but also for his own personal investments, fix and flips and things like that. He's loved the note business. I got an email from him about a month ago, 2 months ago, maybe it was, talking about how he's going to be making a 7 figures in 12 months because of the note business and what he learned from us. If it wasn't for us, he wouldn't have made it. His words, not mine. I love working with people who have real estate experience, but you don't have to have a lot of seasoning like some of these guys do or gals do. One of the beautiful things is I can teach you, even if you don't have a lot of real estate experience. You can learn this business because we do such a great job of teaching people. Like Raphael here is one of our students. No real estate experience, never bought a property, hardly knew what a mortgage was when he got into real estate, but he started learning as much as he could about the note business. Went through our training. And what's great, he lives in San Diego, a very competitive market. He wasn't buying notes in San Diego. He was buying them in other parts of the country. And thank goodness he did, because when COVID hit, him being an entrepreneur in San Diego, business owner, car detailing business, basically went out of business. He had to lay off his 15 employees. And thankfully, he had the note business because he's learned. He bought 2 notes immediately, got them reperforming, bought another 3 notes from a fund. I think he's got 2 of them sold. The third one he's getting ready to sell as well, so still working out, but done an amazing job. And Raph said in his words, he's glad he found the note business because he's got something to fall back on, something that's going to help him change his life. He may never reopen his business again, but he may not ever have to do that because he's learned another way and how to tap into what's going on. And he's in San Diego, but buying in different states across the country for his investments. And we're really excited about what he's doing. We're excited about all of our students, whether they're buying 1 deal or 100 deals. We're equally proud. And that's one of the beautiful things. Like I said, I love helping people change their direction, change their future, change their income, and help them accomplish a lot of big things out there. And we've done this for a lot of people all across the country, hundreds and hundreds and hundreds of people each year, and done this for 10 plus years now, and really help people make a big impact on their lives, the communities, on the bars that they've helped, the neighborhoods, the cities, and the states. Because if one note goes into default and then goes to foreclosure and gets foreclosed on, it affects everybody, not just the borrower. And how do we do that? How do we help people? One of the easiest ways is our one-day class called Note Weekend. You go to noteweekend.com. It's a simple one day, all day, basically 9 a.m. to 3, 4, 5 o'clock at night, depends on the last question asked. But it's an intense one-day training with yours truly. I teach the entire day. We take a couple little breaks. If you go to noteweekend.com, you can actually see the breakdown hour by hour about what we discuss. We call it our kind of Cliff Notes version of training. It's an all-day Saturday workshop. We record it, and you get the replays on Sunday to watch what you missed or what you got to step away from, or to regurgitate it and relearn it the second time. Sometimes going through the second time absorbs a little bit faster. But our students, our past students have come and taken, oh my God, this is the Cliff Notes version. This is great. What a great refresher. What a great starting place for me to dip my toes or my ankle in the water to see if that water is warm if I want to dive in. And that's what we love, is all the great stories we're hearing from our students out there. They love it. They're starting to apply it and starting to do some big things. Normal cost is $99. We dropped the price down to $49, 9 to 3, 9 to 5. Like I said, it's yours truly talking. We usually do this the third weekend of the month. The next one is July 25th. That's a Saturday. And the next one after that's August 29th. That's actually the fourth Saturday of August. But like I said, we do it on a monthly basis, usually the third Saturday. And so what do we cover? Well, we cover the very first part of the day. We talk about where to find the deals, how we find the banks, how we create lists, what do we reach out to them, when do we reach out to them, what do we say, what do we don't say, and go from there. We'll talk about how to raise capital with other people's money, how to find investors in your neck of the woods, how to tap into that 77,000 IRA investors around Dallas County or other investors around wherever you're located, wherever you call home. We'll talk about the 10 different exit strategies, or the 11, 12 different exit strategies, a few other things that pop up there as well. We'll show you how to make money with those exit strategies. And that's an important thing. We'll also talk about the vendors you need. You got to have a team. You can't be going out and doing the foreclosures yourself. You're probably not going to be the one calling the borrowers either. There are vendors out there to help you with this. And we'll actually, people are like, oh my God, do I need to have a lot of money for expenses? No, because we show you how to raise capital, how to buy these deals so that you have your investors fund most of the expenses to cover your butt along the way. Now, if you have money, great. Congratulations. That's an awesome thing. But a lot of people don't have money. So whether you have it or don't have it, we're going to teach you how to raise the capital and how to do things. We'll also share with you some loan trading platforms where you can tap into assets right now. Start looking at deals immediately. Not having to wait 6 months. We'll show you where you can start looking at assets right now. Start making offers. Start getting your systems in place. Start looking at due diligence. And cover a lot more than that too. Just a lot of information in the day. You're not going to learn everything about the note business in one day. I'll tell you that right now. You're not going to learn it all in 3 days. You're going to learn more from taking action more than anything else. And our class is designed that to help you take action. How to have the bank start calling you. How to save money without having to send out direct mail. How to market properly. I've helped thousands of investors, and I would love for you guys that are watching this, to listening to this, catching the replay, to be one of those 1,000 investors that we want to help in the next 12 months. Okay? And we're doing this, like I said, we offer a lot of value, but we're doing this for basically $49. And you know what? We're going to throw in some bonuses for you as well. Besides cutting the cost in half from $99 down to $49 for you, we're going to throw in our 1 day of me calling banks training. That's over 5 hours of you listening to me call banks. We've got a replay of it, but we're also going to do it live later on. Yes, you get to hear me calling banks and being on the phone, seeing who I'm talking to, hearing the conversations. It'll literally a fly on the wall. It's normally $49. We're going to throw that in there. We're going to throw in the most recent Bauer Financial list. Yes, that list alone will cost you $360 if you went and bought it yourself. Who doesn't want to have over 2,000 bank contacts and numbers on banks all across the country that you can see who's struggling, who's got stuff, and who you can start calling today to start making those relationships. We also do a 30-minute one-on-one phone call with me after the one-day class to kind of get a feel for where you're at, where you want to go, help you narrow down your focus a little bit, kind of help you with the next step. I charge $1,000 an hour for consultants. That's a $500 value for you guys. If you want the replays, guess what? The replays are included. You want to have your spouse come or your business partner come? Guess what? That's thrown in as well there too for you. That's included. And of course, we've got a great private Facebook group for our students as well. Almost about 900 members, students. It's a great networking place to connect, to ask questions. Besides just building your buyers list, great way for resources to help you move deals as well. All that's included. That's over $1,000 in value in bonuses. And we're throwing that in. And once again, like I said, all of this for just $49. Just $49. Am I getting rich off that? No. But I'm starting to build the army that I know I'm going to need. So when all these banks start calling me like they do, when they start emailing me with deals, I've got people that I can send deals to that understand what the heck they're doing. No, I'm not going to send deals out to people that have never taken my training, because the note business is completely different than your fix and flip, your wholesale side of things. The note business is its own animal. You got to start thinking like a banker. It's a different mindset, and there's different things that can trip you up relatively easy. So once again, everybody, why should you do this? Why should you sign up for my note weekend? Well, learn how to help borrowers and investors. Learn how to help yourself. Learn how to help the borrowers that you come in contact with, show them the options they can, but also help the investors out there by buying and finding some great deals you can add to your portfolio and to theirs as well. Make money helping people solve problems. It's one of the most beautiful things out there, whether it's banks or borrowers. Buying a note, working on it, and keeping somebody in the property and making it a win-win. Who doesn't want to do that? Okay? This is the opportunity, I believe, of the next decade. We have ups and downs, a bear and bull market. We've been overdue for about 3 years on this market changing. And this is really the true opportunity to build wealth if you really want to do some things. Yeah, you got to put some work in. Work, W-O-R-K. It is a 4-letter word. You've got to do the things that other people are going to do. But this is a whole lot simpler than most people make it out to. And there are people out there telling you, oh, the banks won't sell to you because you're just stupid. You've got no experience. You know what? That's a bunch of bullshit. I had no experience when I got started in 2008, and I had banks sending me stuff. And I can show you how to do the same thing too. Okay? We all know distressed borrowers. We all see distressed properties everywhere we drive in this country. You might as well have the opportunity to just step in and be able to do some good things. Okay? There's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. Let's help them dream the impossible dream, baby. Let's help them get over their fear and realize, hey, that nightmare can turn back into the American dream of homeownership. That dream of owning your own business or owning property, you can do that. Never been an easier time to do it. So much money is in the market, the signs, and so many deals are coming to the market. You've just got to jump in the middle and put the two together, everybody, and you can do it. You can do it. All right? So once again, if you go to noteweekend.com, that's noteweekend.com. Love for you guys to get signed up for this one-day class. Like I said, the mini workshop is the Cliff Notes version. We go all day Saturday. You get the restream of the replays on Sunday. Yes, we get them out not 6 months later. You'll get also a 20-plus page manual with it as well that you can follow through. You go through and make notes on it. We also include links to other videos, other training involved with that 20-page so that I don't have to spend an hour talking about that. You can watch that video on your own time afterwards. Like I said, we'll go from 9 to whenever you guys leave. Roughly the third Saturday of the month. If you go to noteweekend.com, get signed up there for $49. I'd love for you guys and gals to join me. The next one is the next coming Saturday, July 25th. After that, like I said, third Saturday in August. So any questions, comments, concerns out there for you guys and gals out here? We're watching live or watching me on Zoom or listening. I see a lot of yeses. People are interested. That's awesome. If you go to noteweekend.com and get signed up, trust me, you will not regret it. If you take the first part of it, you sign up for Note Weekend, you're like, Scott, this is just not for me. I'll refund your money back. No questions asked. I don't care. But I'm not going to give it to you for free because free has no value. So make the small investment of $49. See if it's something that you want. We even apply that money, $49 if you want to sign up for one of our trainings or a full 3-day workshop or our home study course. We'll apply that to that. So it's like a down payment towards something future. But if it's not for you, I don't want to take your money. So once again, get signed up, noteweekend.com, ladies and gentlemen. I want to thank you for joining me for this hour tonight, talking about the Dallas-Fort Worth market. There's a lot of opportunities right now in the commercial space and short before too long in the residential space. And it's all up to you and how big a piece of that pie you want to get. So get signed up today, noteweekend.com, and help me take you to the next level. All right, everybody. Thanks.